Heading right down, degree of financial leverage. Degree of financial leverage. In bracket write down DFL. Dear students, we understand something like this. Listen carefully. As far as the fixed cost is concerned, fixed cost is divided into two parts. One is given a name as the operational fixed cost, and another is given a name as financial fixed cost. As far as the financial fixed cost is concerned, in that again there are two expenses that we have. One is interest and another is preference dividend. Like that, so there are two fixed financial charges that we have. One is interest and another is preference dividend. Over here, now we are going to understand the effect of the financial fixed cost. And dear students, the effect of the financial fixed cost is measured by degree of financial leverage. As far as the degree of financial leverage calculation is concerned, in that the kind of questions which are asked in examination are divided into two parts. There are certain questions in which we are provided with the information in which there is no preference dividend. There is a fixed financial charges does not have the preference dividend. And there is fixed financial charges in which the preference dividend is included. That is the way DFL calculation is divided into two parts. Dear students, first of all, we are going to focus on a point, calculation of the DFL, in which the preference dividend information is not given. Then we are going to understand calculation of the preference dividend if at all calculation of the DFL if the preference dividend information is given. That is the way we are going to understand that, say, into two segments. One, DFL without preference dividend, another is DFL with preference dividend. Friends, in the financial management, as what we have discussed earlier, the fixed financial charges includes not only the interest payment but also the preference dividend payment number of times. The reason is that, say, over here in financial management, preference capital is considered to be more as a committed sources of finance in comparison to uncommitted sources of finance. This is the logic that we have. So do not write anything, I am just explaining to you DFL, in that if at all there is no preference dividend. I am giving explanation for that. There is a basic formula set to make the calculation of DFL if at all the preference dividend information is not given. It is earning before interest and taxes upon earning before taxes. This is the basic formula with which the DFL is calculated, and DFL, if at all the preference dividend information is not given, is measuring what is the percentage change in earning before taxes and earning per share for every 1% change in EBIT. In a way that, say, for example, DFL is 5, suppose. Then it is measuring that if at all the operating income increases by 10%, then in that case earning before taxes and earning per share will increase by 50%. How this 50% is calculated? 10% into 5. If at all there is a reduction in the EBIT, let us say by 20%, then 20% into 5, there is a reduction in EBT and EPS by 100%. That is what we understand with the DFL value. So understanding that, say the DFL, if at all the preference dividend information is not given, is measuring that what is the percentage change in EBT for every 1% change in EBIT. DFL measures what is the percentage change in EPS divided by for every 1% change in EBIT. Before I proceed further, there is a question from a student. Sir, why do we calculate the DFL? Giving explanation of that question before we proceed further. See what happens at, say there is a term called fixed cost. What will happen? Sales minus variable cost, that gives contribution minus fixed cost, that will give us EBIT. Now when sales increases, at that time operating income increases at a higher rate. When the sales decreases, then in that case the operating profit reduces at a higher rate. So basically, being finance manager of the organization, we need to explain to the management that what is the impact of this fixed cost. If at all you introduce more fixed costs, it means that you have kept more risk in the business, because when your sales will fall down, then in that case your operating income will fall down sharply. So be careful in introduction of the fixed cost in the business. Similarly, for the purpose of financing the capital structure, we understand that, say basically we are having the financing in the business, in which we have the own financing and we have outsiders financing. Technically, preference share capital and debentures are considered to be the outsiders financing, and for that is to them we are required to make the payment of fixed financial charges. So again, what will happen? If at all your operating income increases, then with that, say you don't have to say make more payment of the financial charges. So what will happen? Say your earning per share will increase at a higher rate. For example, EBIT is, let us say, 50,000. Interest is, let us say, 40,000. Earning before taxes is 10,000. Income tax is 40%. That is 4,000. Earning after taxes is 6,000. I am ignoring the reference dividend for the time being. Number of equity shares are 6,000 and earning per share is ₹1. Now suppose the sales of the operating income of the company increases by 15%. So what will happen? 50,000 plus 15%, that comes to 57,500. This is 40,000. This is 17,500. Then amount of tax is 7,000. This is 10,500. This is 6,000. So this is ₹1.75. So when your operating income increases by 15%, your earning per share increases by 75%. Management is happy, management is very happy. That's great. But at the same time, say when your operating income reduces, let us say by 10%, reduces to 45,000. This is 40,000. This is 5,000. This is 2,000. This is 3,000. This is 6,000. This is 50 paise. So from 1 rupee it reduces to 50 paise, reduces by 50 paise. So there is a reduction by 50%. This is what we understand. So when your operating income reduces by 10%, your EBIT will reduce by 50%. So this is what we need to explain to the management, that say this is the effect of introduction of the fixed financial charges. What will happen when your income increases? At that time your, that is operating income increases, then in that case your earning per share, at the same time for EBIT also we can compute the percentage, it increases at a higher rate. When it reduces at a higher rate. So this effect of the fixed financial charges is required to be explained to the management. At the same time, listen carefully, we understand that say we have to tell to the management that whatever the business that say you are going to finance, that business is having too much uncertainty of the business, then in that case you should keep less leverage. Why? Because if at all the sales is suddenly falling down, then in that case you will not be having say the huge reduction in EPS. At the same time, when the sales is going up, in a way that operating income over here, operating income is going up, then in that case your that is earning per share will increase, but that will increase at a lower rate.